Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the ACCA tutor, Mr. Jerry Mtimkulu. In this video, I'm going to take you through question Corfe, which is found from the ACCA PM September 2016 question paper. If you don't have the question paper, you can download it from the link provided in the description to this video below. Okay, the question is related to flexible budgets, okay, or flexed budgets. And if you are preparing for an ACCA PM exam, this question is going to assist you in understanding the concepts behind flexible budgeting. All right, so I want you, ladies and gentlemen, to just first read through the question, or you may just attempt it before you watch the whole video, so that you will understand and update your skills with the video as you proceed with your studies. So let me just show you the question. Okay, this is the question, ladies and gentlemen, and please just go through the question, and you may try it on your own as I've already indicated, or you can just pause the video for now so that you assimilate the information as much as possible, because it is actually a very long question, and then you flow with me. Okay, Corfe Co is a business which manufactures computer laptop batteries, and it has developed a new battery which has a longer usage time than batteries currently available in laptops. The selling price of the battery is forecast to be $45. The maximum production capacity of Corfe Co is 262,500 units. The commerce management accountant is currently preparing an annual flexible budget and has collected the following information so far. So we are given that information as part of the preparation for an annual flexible budget. In addition to the above cost, the management accountant estimates that for each increment of 50,000 units produced, one supervisor will need to be employed. A supervisor's annual salary is 35,000. The production manager does not understand why flexible budgets have been produced, as he has always used a fixed budget previously. And we understand that fixed budgets and flexible budgets are different. Fixed budgets are those budgets where we prepare them without giving regard to changes in the environment or the business operations. All right, and usually these fixed budgets are only given some incremental adjustments, as we maybe consider things like inflation, but we do not necessarily going to adjust the budget based on the changes in sales or production requirements. Okay, so they are usually preferred by production managers because they do not actually keep them busy. All right, so you can see from the statement here that this production manager is actually like surprised or shocked why the company or the management accountant is now having a fuss over the flexed budgets. All right, but that's not what we are required to worry about for now. Now let's read question 21 and understand what it is requiring us to do. Assuming the budgeted figures are correct, what would the flexed total production cost be if production is 80% of maximum capacity? So if production is 80%, it simply means that okay, what is 80% of the total production capacity so far? All right, this would be 80% would be let us just say 80% multiplied by 262,500. Okay, let me just look for my calculator. Okay, but in the exam it is actually useful for us to just use the spreadsheets which would be provided. So we can just simply do these calculations in our Excel. All right, so we are simply saying production. Okay, if actual production is 80%, okay, 80% of uh of how much, let us look back, of the maximum capacity, that is 262,500. 262,500. Wow, we get 210,000. Okay, and then we are told in the question, assuming that the budgeted figures are correct and our uh, um, the actual production is 80% of the maximum capacity. What would be the flexed total production cost? All right, so we now need to determine the flexed total production, and we also have to visit our spreadsheet. Okay, so I think you are still reading those figures clearly. All right, so we have already input our actual production. Now let us determine uh, the the variables. I mean the variable costs. Okay, remember our equation, our normal equation. Let me just try to get this pen working. All right. Okay, we have got this equation, ladies and gentlemen. Total cost is equal to variable cost plus fixed cost. All right. All right. We know that. So let us determine the total. I mean the variable cost so far. Variable costs. All right. For the variable cost, we can establish the variable cost per unit. All right. Uh, First, how do we know that? The variable cost per unit. All right, let me just say variable cost per unit. All right, the variable cost per unit can be determined by, let us say, for labor. All right, let us start with for materials. Okay, because material and labor are variable overheads, I mean variable costs. So let's start with the material cost per unit. How do we determine that? We say the total material cost divided by the budgeted production. So we know that the budgeted production were 185,000. Okay, and at that level the material costs were budgeted at $740,000. So that's the budgeted material cost, that is 740,000 divided by the 185,000 units, and we get a 4. All right, that's a 4. Okay, you can so that the examiners will see what you are doing. Okay, you can put a dollar sign there. Then you determine for labor. For labor, that's 1,000,000 and 17,000. So that's equal sign 1,017,500, all divided by the units 185,000, and we get a $5.50. So this simply means that the total variable cost per unit should be equal sign sum and you get your $9.50. Okay, so in total, okay, the total variable cost, at the production level of 210 obviously would be equal sign this figure multiplied by that figure, and we should get 1,995,000. Okay, but we are told that there were some fixed costs which are given in the question as 750. These ones do not change with the level of activity. As you can see here, the fixed costs are just the same throughout. Okay, they're just 750 throughout at all levels. Okay, you can also try to determine, you can also see that the variable cost per unit did not change, as you can see throughout. So you could have even used the figures where for material, for example, at 200,000 per unit level, the costs were 800, which means the cost per unit, variable cost per unit for materials was $24. That is 800,000 divided by 200,000, and you can see that it was still $4 there. So you know that the variable cost per unit graph, the variable cost per unit is a constant. Okay, it doesn't change, but the variable cost in total do change. The graph do change. It's not a constant line. All right, you know that one from your previous management accounting paper. All right, so there we are done. Okay, there we are done. Let us now consider the cost, the other costs here, which we are told in the question. Remember, the question is saying whenever the production exceeds 50,000, okay, I mean, for each 50,000 incremental production, there is need for a supervisor. Let me just try to show that sentence so that we are in agreement. Okay, you can see this statement. In addition to the above cost, the management accountant estimates that each increment of 50,000 units produced, one supervisor will need to be employed. A supervisor's annual salary is 35,000. This is actually a relevant cost which we need to consider. So it's more of a stepped cost. Okay, it's a stepped cost, or stepped cost, stepped fixed costs, which in this case we are requiring these supervisors, but we are told that for every increment of 50,000 production. So this simply means that, as we know that the production is 200,000, the actual production was 210,000. All right, so the number of supervisors required here is, you can come here, examiners will see that supervisors required or employed. Okay, required, this simply means that this should be equal sign, okay, this figure divided by 50,000, and you can see that we require 4.2 supervisors. But can we have supervisors who are 4.2? Obviously not. We require 5 supervisors. Okay, remember, human beings are just complete people. You can't have a quarter supervisor. It doesn't work like that. So this is why we should be reasonable. Okay, so Therefore, five supervisors required. All right, can just enlarge this cell. Good, so that everything is seen properly. Good, the examiners will see that figure. Okay, so we need five supervisors. All right, but these supervisors, the five of them, they have to be paid a salary, and we are told that the salary for each supervisor is 35,000. So we are going to say equal sign 5 multiplied by 35,000, and we get 175,000 is our cost, and then we have to total up. So because the question was saying, assuming that the budgeted figures are correct, what would be the flexed, okay, the flexed total production cost if production was 80% of maximum capacity? So we are going to say here we get the total flexed production cost. We're going to get equal sign sum. Okay, equal sign sum. Okay, 292,000. Okay, and we can just try to bolden this one. All right. I'm sorry, computer there is starting to get frozen. It's freezing now. Okay, so you can see that our solution is D. Okay, D is our solution there. Then we have to go to another question. The management accountant has said that, let me try to enlarge it. Good. The management accountant has said that a machine maintenance cost was not included in the flexible budget but needs to be taken into account. Okay. The new battery will be manufactured on a machine currently owned by Corfe Co, which was previously used for a product which has now been discontinued. The management accountant estimates that every 1,000 units will take 14 hours to produce. The annual maintenance hour, the annual machine hours and maintenance cost for the machine for the last 4 years have been as follows: machine time in hours, machine costs in thousands of dollars. We have got year 1, year 2, year 3, year 4. What is the estimated maintenance cost if production of the battery is 80% of maximum capacity to the nearest 1,000? Okay, so you can see from the arrangement of figures here we are being driven to the concept of the high-low method, which is also part of this week's lecture for those who are studying with the transfer consulting services. Those who are studying with us, they appreciate that this is actually a relevant area with regards to this week's assignments and so forth. So this question is actually a bonus to them. All right. For those who are just also preparing for the upcoming ACCA PM exam, they are also going to benefit. So let us flow together. This is a high-low method question. So the high-low, we are talking of the highest cost minus, the highest cost the cost at the highest level of activity minus the cost at the lowest level of activity. All right, all divided by the highest level of activity minus the lowest level of activity. All right, you need to actually understand that, because if you simply just rush, sometimes a higher figure could be given to a level of activity that is not higher, and there's going to be some problems in your computation. So when you are talking of the high-low method, we are simply saying the formula is cost at highest level of activity minus cost at lowest level of activity, all divided by the highest activity level minus lowest activity level. Okay, that's the idea, ladies and gentlemen. So we know that this one here, the examiner has been just generous. It was a bit obvious. All right, so the highest level of activity is 5,000. Therefore, we are going to pick $850,000 as our numerator. Okay, and our numerator again is going to have this 450, as it is in line with the lowest level of activity. All right, once we have done that, we just have to imagine that we want a situation where we are saying 850 minus 450 all divided by 5,000, okay, minus 1.8. Okay, remember we have done away with the three zeros, the other three zeros there, so you just have to be proportionate in the way you input your figures. Otherwise, you come up with the wrong figure altogether. Okay, so let us go to our spreadsheet. All this information, you could actually put them in your scratchpad, but remember the scratchpad is not going to be marked by the examiners if you are doing an ACCA paper. All right, so the scratchpad is just for you to just annotate one or two things. All right, but the examiners are not going to mark that. All right, so if you want to examiners to see what you have been doing, you just have to use your spreadsheet. It is actually a mandatory aspect. The use of spreadsheet is actually advocated for these days by the ACCA. So you need to brace up for the use of spreadsheets. Okay, so let me try to put this question here. Okay, I'm sure you're still seeing what is going on. All right, okay, let me just try to zoom in, but the more I continue to zoom in, you guys won't be able to see what is happening. Okay, and I might as well try to erase some of these so that you see what is going on. Okay, better. All right, let us come to our Excel. Let us put this information. Okay, like I have indicated, we should have done it. Okay, highest oh, my spelling, highest activity level. We have got 850,000. Okay, we are still here, ladies and gentlemen, don't be lost. 850, sorry, thousand. Okay, and this should be in dollars. Okay, these are dollar figures. They are dollar figures, and these ones are now units. Okay, units. and the units are 5,000. Okay, they're not really units but hours. And then we have got the lowest activity level. Okay, for the lowest we have got in terms of money 450,000, and that is in line with our activity level 1.8. Okay, therefore remember this formula is for us to calculate the variable cost per unit. We are trying to calculate the variable cost per unit, so you come here and say variable costs per unit is equal to just have to use brackets here. Okay, 800. Okay, we can simply say this figure, all right, minus the lowest dollars, all right, you close your brackets, all divided by open bracket, that figure minus that one. And you can see that your variable cost per unit is $125. Okay, but one thing we appreciate is that we understand that there is this figure, this formula, total cost is equal to fixed cost, or variable cost plus fixed cost. This time fixed cost plus variable cost. Okay, variable cost, which means in this case it's variable cost per unit multiplied by the level of activity, which I might call X or Y, whatever. All right, so in this case if we are using the level for 5,000, we can still calculate the figure as our X would be 5,000. all right, so we are going to come here and say total variable cost okay, at 5,000 hours. That's our activity level which we have chosen. So we are going to say since the variable cost per unit is 125, we're going to say equal sign this figure multiply by 5,000, and we get 625,000. Okay, we have done justice to the variable costs. Okay, we have determined the total variable cost. Now let us determine the fixed cost. All right, so we have our equation as we have indicated here. All right, our equation is now available. So we now know that at 5,000 level of activity, the total cost at that level is given by 850,000. So we are saying we have got 850,000 here, which is about fixed cost plus the variable cost, which we have just calculated as 625,000. So therefore the fixed cost should be 850,000, all right, minus 625,000. So in simple terms, we are going to come here and simply say fixed costs is equal to this figure minus this figure. Okay, some examiners might simply want to know how you have arrived to that conclusion. You can simply say, in this case, TC is equal to FC, okay, plus VC. You are done. Once the examiner saw that, he will be happy. You would know that his student knows what he is doing. Okay, we are done there. So, but we are not yet done. All right, we haven't answered the question as yet. So we need now to get busy a bit. All right. So now that we know the fixed cost, because the fixed costs usually do not change with the level of activity, so what is gonna change is the variable cost, right? So we come here and say, because we need to answer the question. The question, ladies and gentlemen, let me put it across again. The question is saying, okay, the question is saying, what is the estimated maintenance cost if production of the battery is 80% of maximum capacity? And we have determined that if the capacity is 80%, therefore we are going to produce 210,000. However, from this particular scenario, we are told that this new battery, okay, the new battery will require a machine which was previously used for a product which is no longer there. Okay, the management estimates that every 1,000 units of these new batteries will require 14 hours. So therefore, how many batches are we going to produce? All right, because when you are talking of 1,000 units, it's almost a batch. It is a batch, ladies and gentlemen, and there is no way out. Okay, there is no way out of this. There is no way, I mean, nothing more about this except that we just have to consider it as a batch. All right, we are talking of batch costing. So in this case, we are going to say number of hours, all right, required, all right, because our activity level is in hours. Remember, we are talking of hours. So you're gonna come here and say maximum capacity is 210,000. All right, or to be a bit simplistic, adjusted maximum capacity, because we now know this is the adjusted. All right, the 80%, it was originally 2.9 something from the question. All right, but the examiner is simply saying if it is now 80%, how are we going to do it? So that's 210,000. It seems it's 21 million. 210. This one, it seems it's 2 million. All right, 210,000. Okay. Now, each 1,000 is taking 14 hours. All right. So, how many hours are we going to spend producing all these units? We are going to say, okay, number of batches, number of batches, number of batches. A batch is what it has got 1,000 units, so number of batches is equal to this figure divided by a 1,000, and we are going to have 210 batches. All right, and each batch is taking 14 hours. From the question, we have learned that each batch is taking 14 hours. So number of hours number of hours is now gonna be 11, equal sign 14 multiplied by the number of batches. Therefore, we are coming to 2,940. Okay, now when we are here, we then have to come back again to our equation, all right, and we need to determine what's going on. Okay, so the equation is still here, ladies and gentlemen. All right, we're gonna say here, all right, okay, therefore the total cost now, total cost for 2,940 batches is equal to, we know that the total cost is fixed cost plus variable cost, and we now know the fixed cost. Our fixed cost is this one, the 225, all right, plus opening bracket, okay, 294, okay, 29,040, all right, plus the variable cost, multiplied by the variable cost per unit, which is this one, and we have to get our answer. So you can see that here we determined 592,500, and we just have to get to our answers and to see what is happening. You can see that from the choices given by the examiner, we do not have that number, so we just have to pick a number, a figure that is almost closer to that. So in this case, you can see that 593 is a bit closer. Okay, so our answer there, that's 593. So our answer is B, and we are done. Sorry. Okay, I'm sure we are done with that part. That's the high-low method for you, ladies and gentlemen, as you would be preparing for your forthcoming ACCA PM exams. Just have to remember that there is nothing fishy, nothing complicated about the method. Just practice makes it perfect. Okay, practice makes it perfect. Now let's continue with our question, ladies and gentlemen, so that we finish our work as soon as possible. We are given that question again. In the first month of production of the new battery, actual sales were 18,000 units, and the sales revenue achieved was 702,000. The budgeted sales units were 17,300. Based on this information, which of the following statements is true? Okay, it is clear that this question is a bit challenging. Okay, it requires us some understanding of variance analysis with regards to these two variances, the sales price. Where's my pen now? Okay, sales price variance as well as sales volume variance. Okay, but one thing I want you to appreciate is that we are not actually being required to do any computation for these variances. Okay, we simply have to come up with some logic. All right, so as you can see, the solutions have nothing to do with the variances, the ultimate variances, and so forth. So you need to crack your head all the time when you see figures. Sometimes it's just an issue of simple logic. However, you need to understand what would be going on. Okay, so in the exam, sometimes using the concept of elimination, you just have to uh, find these things correct. Okay, we appreciate that the sales price variance is all about determining some variance in profit. Okay, we are talking of the profit following a change uh, from a change in price. Okay, from a change in price. If we deviate from the price planned, sometimes uh, it might result in an adverse situation or a favorable situation. Okay, so the sales price variance usually tells us more about the effect of a profit or selling price change. Okay, the effect on the profit of a selling price change from expectations or from the budget. Whereas here the sales volume talks us about the units, the quantities. Okay, we are talking of the units here. Okay, we are talking of the units. All right. So this should be the difference between the planned production or planned sales uh, and the the actual sales in units now. Okay, remember the issue of units, but like I said, we are not talking much about these figures. The computations are not actually being required, but for interest sake, let me just try to find a place where I can write these formulas. Somebody might actually want to know them. All right, formula for sales variance. Sorry, what's going on with the pen? Pen, where are you? Where are the pens? Let me try to find a pen. Hope this one is gonna be fine. Okay, and good, fine there. It's okay. Oh man, I need some blessed to write these things. Okay, now we're gonna say here, hey, what's going on? Pen, what are you doing? What's happening with the pens? Okay. Oh man. Okay, it doesn't matter. These pens. Okay, it seems the PowerPoint refuses. Doesn't matter. Okay. I hope here this formula could fit. Okay, for the sales variance, sales price, we are saying variance is all about the change in actual quantity. Okay, actual quantity minus um, the the standard quantity. All right. Um, okay, actual quantity multiplied by um, actual price minus actual quantity multiplied by standard price. All right, so simply we are simply saying this should be um, actual quantity. Okay, actual quantity in bracket uh, actual price minus standard price. Okay, actual quantity multiplied by actual price. All right, minus actual quantity multiplied by standard price, which if you just bring out the AQ outside the brackets, you will have the actual quantity multiplied by actual price minus standard price, and you get your sales price variance. Then when it comes to the sales volume, okay, for the volume we just say sales, what's going on, the pen where you, okay, sales volume variance, we simply have to say uh, this slide of mine better, the volume is going to say, we are going to say um, actual quantity multiplied by standard price minus um, standard quantity applied by standard price, and this should be standard price multiplied by the standard price multiplied by actual quantity. Sorry, oh man, this is disturbing the flow. The flow. All right, we try not to make those mistakes. Okay, actual quantity minus standard quantity. All right, so this is these are the the formulas, ladies and gentlemen, but they are not necessary for now. Okay, they aren't necessary. We need to appreciate what is happening. Okay, um, as I have indicated, you can see that this one is actually largely about the variances in quantity. As you can see, these are quantities or units, right? And here we are talking of the prices, because the prices are inside the brackets. As you can see, the actual price minus standard price. All right. So when this budget is flexed, right? Um, what would happen to the based on the information, which of the following is true? Okay, so what will happen to these variances if we flex them? All right, let us look at D. You can see when the budget is flexed, the sales variance will include the sales mix. You can see that this one is actually an odd one out, because we're not talking of mixes. We are simply having one battery to talk about. We're not talking of so many products. We are just talking about one battery. Now, A is saying when the budget is fixed, the sales variance will include both. I mean, when the budget is flexed, the sales variance will include both the sales volume and sales price variances. Flexing does not going to change how the formulas should be. All right, so you can also see that this one is out. Then when the budget is flexed, the sales variance will only include the sales volume variance. This one again is not true, because these formulas are not going to be changed because of flexing. Then C, when the budget is flexed, the sales variance will only include the sales price variance. All right, this one um, is a bit true. Okay, okay. Let me try again to wrap this part and explain this point together. with what we have already covered. Okay, let me try again to remove this one. All right. I've already indicated that the sales variances are 2. Okay, and we are talking of the sales. What's happening with my pen? Okay, the sales price variance and the sales volume variance. Okay, but from the formulas, as you can see here, the sales price variance is talking about the actual quantity vis-a-vis the changes in price. Okay, they multiplied by the changes in price, that is the actual price minus the standard price. All right, so you can see that from this formula, if we do any flexing, we are actually measuring or matching the actuals versus the flex actuals versus the flexed figures. Okay, but if we look at our the sales volume variance, we are having the standard price multiplying, which means the budgeted price multiplying by multiplied by the actual quantity minus the standard quantity. So in other words, we are having a situation where the flexed budget is actually being compared with the original budget. Okay, so in this situation, we are having B and C as our answers. Okay, but B lacks in that when the budget is flexed, the sales variance will only include the sales variance. The sales volume variance. This is actually wrong because we are told that there have been some actual. Okay, let me try to rub there for you guys. If you look here, the question, the wording of the question is telling us that in the first month of production of a new battery, actual sales, we are given the actual sales there. Okay, actual sales were 18,000 units and the sales revenue achieved was that one, which means the budgeted sales units were that one. Okay, so in this case, you can see that if the budget is flexed, all right, we are going to have a situation where the actual quantities are being regressed with the difference between the actual price minus standard price, which means in this case we are only going to have the sales variance as the ultimate variance representing the sales variance altogether. We're not going to see the sales volume variance participating because this variance is actually a match between the flex budget versus the original budget. All right, that's what the sales volume variance tells us. It doesn't tell us about what about a comparison between the actual sales versus the budgeted sales in price terms. Okay, so this is why C is better. All right, but we need to you need to read around that area, the theoretical part of these variances, to see what is happening. However, we have got a dedicated video for the variances that is also attached to this channel. You can just refer to that video to understand more about these variances. Okay, let's discuss the last two questions and we call it a day. let me try to erase this clutter. Okay. Okay, question number 24 is saying which of the following statements relating to the preparation of a flexible budget for the new battery are true? All right, so here it's almost like a theoretical question, and for you to succeed in such a question, you need to have read much of the theory about budgeting, especially in particular flexible budgets, uh, in in depth. Okay, so you should have done much of the groundwork in terms of reading. Now, item number one is saying the budget could be time consuming to produce, as splitting out semi variable costs may not be straightforward. Yes, that one is a bit true because it's a bit complex to determine the actual splitting points when with regards to variable and fixed costs. So um, it's a bit time consuming and complex. All right, remember, variable, I mean, semi variable costs are a combination of both fixed and variable cost elements. So that one is a bit true. Okay, um, this one is true. Number two, the range of output over which assumptions about how costs will behave could be difficult to determine. Yes, that one again is actually true. It's an issue of um, coming up with estimations and so forth, but we do not have a solid base to actually say uh, this is the accurate thing. So it's about estimation. So this is why they are saying the range of output over which assumptions about how costs will behave could be difficult to determine. All right, we are not quite certain if the behavior at which we attribute a cost is going to be as such. For example, we might have assumed that the supervisor's salary is going to be fixed, right? But you discover that maybe it might turn out to be a variable cost, okay, due to some changes in um, regulatory requirements or something that could have come up during the course of production. All right, so the assumptions might not be easy to come up with. So this one is also true. The flexible budget will give managers more opportunity to include budgetary slack than a fixed budget. This one, the budgetary slack is like some form of buffer, okay, or some contingency. Contingency, all right. In flexible budgeting, such type of preparations or emergencies, okay, or precautions, they are not there, uh, but they are common in fixed budgets, all right, where uh, let's say the managers would have anticipated that the maintenance costs in the coming period are going to be $2 million. However, they put an extra allowance for to come to say 2.1 million to cover for any contingents that could happen. But such a thing is only prevalent to those who are doing incremental budgeting, all right, or fixed budgets, all right. But in flexible budgets, such type of a thing is not common. So uh, the three is actually out. Okay, three is not. So anything with a three, you just have to ignore it. Then the budget will encourage all activities and their value to the organization to be reviewed and assessed. This one is actually not part of flexible budgets. Okay, flexible budgets they do not, all right, they do not uh, encourage managers to review all the sectors of the company or the business. um, that one is usually done in zero budgeting. Okay, when we are talking of zero budgeting, okay, this is a budgeting system that gives managers uh, such tasks as to justify or to review whatever sector of the organization to come up with uh, the most relevant uh, costs or budgets to consider. Okay, I mean, to relevant activities to consider when budgeting. All right, so in flexible budgeting, such is not always the case. All right, so you can see that 4 is also out. So the only solution we can have is A. Okay, once we said zero based. Okay, zero based budgets. That's a ZB. Um, for 4. All right. Now the last question is question number 25. All right, number 25. I'm sure you're still seeing it clearly there. The management accountant intends to use a spreadsheet for flexible budget in order to analyze performance of the new battery. Which of the following statements about are benefits regarding the use of spreadsheets in budgeting? Okay, so here you are required to show your appreciation of budgets. In relation to the use of spreadsheets. All right, so you need to determine which ones are actually um, the best. All right, not the perfect solutions, but the best given the evidence they given those points. Which one do you think is actually in support and is actually truthfully supporting the use of spreadsheets in budgets or in budgeting? Okay. You've actually seen when we were using spreadsheets. Okay, this is the spreadsheet, ladies and gentlemen. You can see that I can change input. Figures. I can as well change whatever these items. I can change them, right, whenever I want. All right. Now, uh, you've also seen that when I was using the spreadsheet, I could do the work easily in terms of inputting formulas and so forth. So here we are being asked this. It's almost like a general knowledge question. All right, if you know how to use these spreadsheets, you can easily pass this question. However, it is also a bit tricky because some of the solutions which will be provided by the examiners would be confusing. So let's go. Let's go. Let's rope the question, uh, attacking one item by item. So item number 1 is saying the user can change input variables and a new version of the budget can be quickly produced. As I've already indicated, you have already seen that you can easily change input and change whatever variable you want to put or to remove on the spreadsheet. So this one is actually true. Then the errors in the formula can be easily traced and data can be difficult to corrupt in a spreadsheet. This one now is not true. Okay, sometimes you make an error in inputting a formula and it will be not an easy task to determine where the error was done, especially when you were preparing a budget for a big organization. You might discover that it is going to be a horrible task to determine where the error was actually input or made. So 2 is not um, the best answer there, or best option. What about 3? A spreadsheet can take account of qualitative factors to allow decisions to be fully evaluated. Although we input some, as you can see, there's been some narratives. It is part of our preparation for these. We input these. The spreadsheet allows you to input text, but doesn't mean that this text is going to be manipulated by the spreadsheet itself. All right, the spreadsheet is a bit quantitative software. Okay, these figures are only going to be manipulated in terms of formulas and so forth. So decisions are actually going to be driven from the manipulation of this quantitative data. So it is not actually the qualitative ones, these text and so forth, which are going to be manipulated. So by such fact, we can safely say item 3 is not correct. What about item 4? Managers can carry out sensitivity analysis more easily on a budget model, which is held in a spreadsheet. This one is correct. Spreadsheet enable us to perform the what if analysis and so forth, which are in line with the sensitivity, and they are also quantitative analysis. So in that case, we can safely say our answer there is 1 and 4, that is C. Okay, ladies and gentlemen, I hope you have benefited from this video. Okay, if you want more coaching, please just get in touch with me. I'll always be there to assist you. All right, I'll always be there, and you can also get in touch with me on these contacts. All right, you can get in touch with me. That's my number there, or my email anytime. All right, it's tea time. We teach during the day, during the night, and time. We are always going to be available. Do not forget to subscribe, to share, to like the video, or even to input your comments on the comment section below, so that we may improve. Other people will be helped who are in our community. All right, so until next time, ladies and gentlemen, may you continue to feel excited, very, very excited. I am signing out.